Good afternoon, everybody. I'm Helen Ferris, and on behalf of the MGAA, I'd like to welcome you to our webinar this afternoon, which is being delivered by Gamma Location Intelligence. Before I introduce our presenters, I'd like to ask you to please ensure your microphone and camera are both switched off. If you'd like to ask a question, please use the chat button at the bottom of your screen, and these questions will be answered during the Q&A session at the end of the presentation. If we run out of time, these will be answered post-event. The presentation is accredited for CPD points if this is relevant to your ongoing professional development. The PowerPoint presentation will be made available after the presentation, and the recording of the webinar will be uploaded to our website and YouTube channel. Please take time to respond to our feedback survey, which will be issued after the webinar. So today's webinar, Expanding Property Risk Platforms to Assess Climate Change Impacts, Data, Business Processes, and Regulatory Requirements, is being delivered by Richard Garry, Chief Commercial Officer of Gamma LI, Johnny Matamore, MD, Global Head of Risk and Sustainable Finance from First Derivative, Alistair McGregor, COO, Sust Global, and Feargal O'Neill, Chief Executive Officer, Gamma LI. I'll be handing over to Feargal, who is a highly experienced location intelligence pioneer and co-founder of Gamma LI. He became Managing Director in 2001. A graduate of Trinity College, Dublin and UCD with a background in planning and the spatial sciences, Feargal has extensive experience in advising insurance companies on using location-based data in their operations to reduce cost, drive efficiency and improve business processes. So Feargal, if I might hand over to you.
Thanks, Helen, and good afternoon, everyone. Firstly, let me introduce myself and my fellow speakers today. As Helen mentioned, I'm Feargal O'Neill from Gamma Location Intelligence. I'll be setting the background context for MGAs and ESG and defining the technological challenge. I'll be joined afterwards by Richard Garry, a colleague of mine in Gamma. Richard's our Chief Commercial Officer, who has a wide experience in applying location intelligence technology to insurance-related challenges in the UK and Ireland. Richard will look at how risk assessment platforms will consume and report on climate change risk analysis and data, which indeed is stipulated by such bodies as Lloyds and the PRA. I'll then be joined by Alistair McGregor from Sust Global, a very innovative company based in San Francisco and London that creates climate change models and data, and he'll present on how these climate change models are created and their use in property risk assessment. And last but not least, we'll be joined by Johnny Matamore from First Derivative. Johnny is a global head of sustainable finance at First Derivative, and First Derivative are a company that provide a wide range of risk-related services, especially in sustainability, climate and ESG areas. And Johnny will present on the impact of climate change and pricing, valuation and risk. So our learning objectives today are firstly to look at the technology available to assess this new environmental property risk and understand the changes associated with physical climate risk. The second one will be taken by Alistair, which is looking at the understanding the current state of development of these specific climate risk models and APIs. And finally, Johnny and indeed myself in setting the context will look at explaining the regulatory requirements and identifying potential requirements for MGAs. So just to, I suppose, look at our focus, in terms of ESG and insurance, we could have a week-long seminar. So we're going to be very focused for the hour. We're only going to focus on the E from ESG. So we're only looking at the environmental side. Secondly, we're only looking at how that applies to property, both home and commercial. We'll focus on the climate change impacts. There are other impacts clearly in biodiversity and other impacts, but we believe from a property point of view, they're less critical in this case. We're going to focus as well, particularly on the underwriting operations. But I'd add that the points made for underwriting are equally relevant to investment and claims reporting. And we're specifically going to look at how technology and data advances will offer practical assistance to your requirements. So the current applications of property data. Many of you will already use digital property data through APIs or directly to the data itself. Underwriters, for example, use the location of property in relation to current environmental perils and accumulations to assess exposures and make pricing decisions. In the UK and Ireland, the perils primarily impacted by location are flood, subsidence, fire and burglary. In general, the concern at present is events only over the policy term, which is typically 1 year. And property data is also used to speed up pre-filled processes. So you may indeed have exposure to property data through online quotation processes, reducing form capture requirements and speeding up transactions. So if we look at the types of climate change impacts that will affect property, it's really divided into three risks, three fundamental risk types. Physical risks are the easiest to describe because that's basically the environmental perils and the changes that will arise due to changing environmental conditions through climate change. So increased flooding, things like that. Transitional risks relates to risks that are associated with changing over to a low carbon policy. So things like the costs of retrofitting properties, loss in the value of properties, poorly performing properties, regulations, compliance costs, and finally the liability and regulatory risk, which there's a little bit of crossover with transition, which really looks at the impact of the emissions that are coming from the properties themselves, the greenhouse gas emissions, and potential liability and exposure to either fines or indeed lawsuits from that. So if we just go into a little bit more detail on those types of risks, physical risk impacts are divided into a number of different, I suppose, aspects. The first clear one is that risk zones are going to expand. The geographical extent of areas that are currently under risk from climate-related perils such as flooding and subsidence are going to be extended significantly over the coming years. The severity of these perils, including flood, the level of impact is becoming greater for many of the perils, not all of them. The frequency in which they will happen, again, in some cases, the return periods are becoming much more frequent. And I know Alistair will get into that area much more in his discussion around the creation of climate change models. But equally, once we've identified where the risks are, the frequency, severity, we also then need to apply that in terms of financial models to identify how does that impact on the value of the property and on the value of the financial products. And Johnny, will elaborate further on that. And finally, what are the regulatory requirements that need to come with these climate change physical risk impacts? There's obviously additional requirements for reporting and additional requirements for actions in terms of tracking and indeed informing customers of these changes. Just to give it some idea of how big a problem this is, Gamma and partners in Ambiental, a flood analysis company, recently produced a white paper looking at the impact, the likely impact on property in the UK of climate change, particularly in relation to flooding. And that analysis uncovered and estimated that there will be an additional 1.3 million residential commercial properties in Great Britain will be newly at risk of flooding. So basically, it's going from the current number of about 1.7 million up to 3 million properties will be within zones that are liable to flooding by 2050. So it is a really significant impact in terms of physical change that's coming. Climate change liability risk impacts, and sort of merge that a little bit, transitional risks. What we're really talking about here is the impact of greenhouse gas emissions from the property itself. So this really relates to the regulatory, non-compliance, fines, impacts for not pursuing these ESG policies. And potentially in the worst case scenarios, and I know Clyde and Company spoke to you a number of weeks ago about the legal impacts and about cases that are happening globally in terms of lawsuits against companies not engaging in appropriate climate change policies. They can potentially result in the companies being sued for contributing to climate change. So what we're talking really about in this particular impact is properties and impacts that fall within the Scope 3 classification. So how your customers are being impacted by climate change. In terms of data in this area, for assessing this particular climate change emissions for property, we're probably talking most about EPC data, which is open in the UK, in England and Wales. Banks are certainly already defining them as financed emissions, and they're trying to estimate their impacts through green loans, lower mortgages. And indeed, insurance companies, insurers are also looking to track, reduce and affect changes in their insured client properties. For example, AXA globally are looking to offset the carbon impact of their motor policyholders. And recently in the island of Ireland, both Southern and Northern Ireland, they spent 6 million euros in offsetting the annual carbon impact of over 650,000 cars. So insurers, it seems a bit of a stretch, but insurers are indeed taking responsibility for the carbon emissions of their policyholders, but in motor. And very soon that will also be seen in terms of homes, with them taking responsibility for that too. In terms of key publications and organizations involved in this, I'd recommend that you look at a number of key publications. To start off with, I suppose the Bible in this area is the TFCD, or the TCFD, I should say, the Task Force on Climate-Related Financial Disclosure Status Reports. That's the ultimate source that all the other reports really relate back to. The Bank of England, the PRA, their supervisory statements, particularly SS 319, and indeed their recent 22-23 business plan, have a lot of guidance on incorporating ESG policies into business operations. The United Nations Environment Programme's Finance Initiative, they have principles for sustainable insurance, and they have a lot of good principles as well. Just go back to the previous slide there, Richard, please. So they have a lot of good principles, and largely the basis for the two most relevant UK summaries, and that's supplied by Lloyds. So Lloyds came out with two very good reports, one in 2020, looking at just ESG report 2020, and then they followed that up in October 21 with a very specific one for managing agents, which I'd absolutely recommend. I'm sure many of you have read this, which is looking at specifics guidance for managing agents. And if we just go into some of these reports and take a view of some of the points that they're raising, Richard, we can go into the next one. The UN program, the UN Environment Program, the Principle for Sustainable Insurance, they've identified a couple of things I've highlighted here. So first of all, in terms of its policy under Principle 1 towards risk management and underwriting, they suggest establishing processes to identify and assess ESG issues inherent in the portfolio and be aware of potential ESG related consequences. Particularly, they're looking at integrating ESG issues into risk management, underwriting, and capital adequacy decision-making processes, including research models and analytics tools and metrics. So really, broadly are the area that we're looking at today. They also add that which is interesting, that they expect organizations to provide clients and suppliers with information and tools that may help them manage their ESG issues. So that feedback back to clients of where there might be climate change impacts in their portfolios or books is also mentioned here. Okay, the Lloyds report largely follows that United Nations Environmental Programme principles in terms of following their approach. And if you go on to the next one, that's covered in the Lloyds guidance for managing agents, where again they're suggesting that each managing agent should define a risk management system that responds to ESG risks, including the financial risks of climate change in line with the Bank of England PRA supervisory statement, and indeed data and reporting used to monitor and disclose an ESG. Okay. In terms of underwriting, the guidance again further goes on to say that MGAs should identify policyholders that pose the most material ESG risks from their underwriting activity. And the risks they're specifically looking at are exposure to climate risk. And to facilitate this, managing agents may require additional ESG data. So there is an anticipation that there's a need to upgrading existing systems, data sets, and insights to meet the requirements that the regulators are looking for MGAs to apply to. Okay, so in summary, in terms of the relevant expectations that are there, in 2022 is really the year they've established as setting up these ESG frameworks, governance, and strategies. So I suppose it's getting a house in order year for MGAs. They're identifying policyholders' exposure to climate risk. Engaging with them is also a key thing that is mentioned in all the documents. Identifying a risk management system that responds to these risks, including the financial and physical risks of climate change. Reporting and monitoring on environmental impacts. But I suppose on the positive side, they've also identified that where there's new risk, there's new opportunities. So there's a whole range of product opportunities that will arise out of these new risks that are emerging, these new requirements. And that's mentioned in all the guidance documents that MGAs should be looking at identifying new products that they could bring to market in light of these requirements. So I suppose in summary, in terms of the property analysis required really, and from a data and a technological point of view, really we're looking at, in terms of assessing physical risk from climate change scenarios, we need to identify that individually and for entire portfolios of books. And secondly, we need to monitor and report on the greenhouse gas emissions from the properties that we are covering. Mainly this is going to be available and possible through EPC, open data, and modeled estimates. Okay, so that's broadly the areas and the relevance to the whole area of property. So I'm going to move on now and look at, pass over to Richard. Just go on to the next slide. So Richard is going to now look at how we can modify and enhance the existing risk assessment and underwriting platforms that we have with additional data, which Alistair will then go on to speak about, to meet some of these challenges and requirements that the regulators are putting to us.
That's great. Thanks, Feargal, for that. Good afternoon, everyone. So what I'll do is I'll start by telling you a little bit about Gamma and what we're doing at the moment and some of our plans for the future. So Gamma are an established geospatial analytics company. We've been providing insights and solutions for it's almost 30 years now at this stage. Our solutions have evolved over time from desktop type solutions to private cloud, private data web farms, to now being totally cloud native. And advances in various technologies and our continued investment in R&D and focus on innovating has allowed Gamma to improve our products and adapt to our clients' ever-changing needs. Gamma have developed solutions for various sectors. we work with telcos, retail and banking, but our focus over the last 7-8 years has been on the insurance sector. But I think with our experience in other sectors, this has given us a slightly different perspective as well. Gamma have worked and continue to work with some of the biggest international brands in Ireland, including Allianz, Aviva, Liberty and Zurich. And through working in partnership with our clients, we've developed a number of solutions, including Peril APIs and Peril Finder, which is our enterprise-grade mapping solution that allows underwriters to review referrals and high-value properties. As a result, we've developed an enterprise-grade cloud-native platform which is built to deliver access to the right data at the right time, so as underwriters need it. We focus on making our solutions user-friendly, but also easy to integrate. And making the solution easy to work with has made us certainly a few developer friends over the years. And we do this by providing and building simple APIs that are well documented, so making life easier for those developers, but also being available to answer questions when they arise. In the last 2 to 3 years, through our investment in R&D, we've developed out these APIs and underwriting mapping solution to cover all of the UK. This has been further expanded in recent months to accommodate climate change data to future-proof our offering. And through our development of a SaaS-based pricing model, we can now provide access to this solution to MGAs for a lot less based on usage bundles. The solution is also available to capacity providers and carriers to provide to their clients and users if required. Peril Finder also incorporates extensive reporting dashboards, so management can review what is happening in their book over time, but also across various books of business, no matter who is writing it. Now, none of this would have been possible without our great partners, such as JBA Risk, BGS even, the British Geological Survey, Ambiental Risk, Terra Firma, MetSwift and the Ordnance Survey, just to name a few. And through integrating data from our partners, we can provide access to their data through our APIs and within Peril Finder. Where there are gaps in our offering, we use our in-house team of geospatial experts and data scientists to develop data and models. But through our research and development over the last while and investment in climate change, we've identified other partners that we're now working with, including Sust Global and First Derivatives, who we'll meet later, and who have expanded our knowledge and reach beyond these islands. So in addition to developing our own data and working with partners and making the data available through APIs, Gamma have developed Peril Finder, which is our underwriting mapping solution. Peril Finder allows the clients to identify property level location risk very quickly. Peril Finder is a solution originally built for large insurers, but is now available to MGAs and those capacity providers looking for something new in this space. It works very simply through a standard browser. The user logs into the solution, enters an address or a postcode, and is immediately presented with the RAG scores for the perils that might affect that location. The results are displayed quickly, and the simple RAG scoring, so RAG scoring is the red, amber, green color coding of the perils, makes it easy for the user to make decisions. Gamma use building footprints to identify the risk at that exact property rather than at bigger geographies like postcode or by drawing a property, a circle around the location. Peril Finder's front end has been customized and tweaked through our work with our partners and feedback from our clients to make accessing peril data as easy as possible for the underwriter. It's designed to allow the user to view the relevant data, but also contains other click-throughs to provide more data if required and more insights. The map element allows the user to zoom in, zoom out, pan around the map, change it from a map view to aerial photography, which allows the underwriter to put that risk into context. Peril Finder also allows the user to explore the data in more detail. For example, to see what type of flooding might affect the property, such as coastal, fluvial, or pluvial. So that's your river or flash flooding. In this example, we can see that the river flooding risk is quite high, especially in the 1 in 20 or 1 in 75 return periods, with quite a high inundation. Peril Finder also allows the user to create accumulation reports, either for preset distances or areas, or for ad hoc reporting using Peril Finder's extensive drawing tools. So here, a property of interest has been identified, and immediately we can see on the left that there are already 4 commercial and residential policies within 200 meters, with a total sum insured at just over 7 million. In another example here, we can see that within a 500 meter circle, a circle that we drew ourselves, there are 5 policies with no historical claims. That's summarized at the bottom of the screen. And we can also review the actual 5 commercial policies and drill into them and get more detail if required. And that data can also be downloaded for further analysis and output from Peril Finder. And further, within the tool, the data can be fine-tuned through filtering using standard queries. So, for example, we could look at show me all policies with total sum insured over 1 million, but maybe less than 10 million within the area of interest that maybe is near a fire station. So you can build your own queries within the tool. We've also developed different versions. So some users can only access the minimum amount of data, while others in the organization can review in more detail if required. Handy for, say, call centers or low margin policies, where you don't want staff getting distracted by the functionality within the tool. Peril Finder also contains extensive organization and user management controls, which allows a company to control who can view, access, and edit the data. Now, a natural fit for Gamma, due to our experience in flood risk and spatial analytics, was to look at how climate change would impact flooding and other perils in the future. So our partners in flood, ground movement, and other weather-related areas are very aware of the impact that climate change is having already, and have developed models that allow organizations to understand the impact of climate change on their business in the future. So in this example, we can see how a property in Bristol has a very low flood risk at the moment, but this could potentially change under certain scenarios and time horizons. So while the property still has a low risk in 2030, the risk of flooding increases beyond that date. 2050, there's an increased risk of flooding, and by 2080, a significantly higher risk. And again, the RAG scoring of the within Peril Finder calls that out quite well. Something we're working on at the moment is incorporating Sust Global's APIs into Peril Finder, which will extend our geographical reach and provide access to further perils relevant to other countries, say like wildfire in the US and Australia, or wind, hurricanes on the US East and Gulf coasts. And Alistair will talk about this in a lot more detail later. Gamma continued to research the effects of climate change and have written a number of white papers that Feargal talked about earlier. These report on identifying the impact of climate change on both ground movement and increased flood risk across the UK. So they're included here as a slide, and MGA will share this later so that you'll be able to actually access these. They're available on our website as well. One final point before I hand over, it's a new area that we're working on, well, not so new at this stage, is AddressLink. So it's our building characteristics and data enrichment solution. So Gamma have already built out an extensive data repository for Ireland and Northern Ireland, and we'll be launching our GB version later this year. So AddressLink will be available and is available through APIs, but also incorporated into Peril Finder, allowing underwriters to access property characteristic data when assessing a new location. Address link includes EPC in energy performance certificate data and other information necessary for the tagging and estimation of greenhouse gas emissions at property and aggregated book level, which is becoming obviously a lot more important. So I've covered, I suppose, a lot about Gamma and what we do and where we're going in the future. I'll now hand over to Alistair from Sust Global.
Hi, Richard. I'll actually we have a quick question there, Richard. You mentioned that it was easier for developers to integrate the APIs, but what about the mapping tool?
Yeah, that's actually easier, or should be easier. So it's relatively straightforward. We just need a list of users, really. The standard tool is all set up. A list of users, we register them. Someone can be up and running in a matter of hours. Now, they may want to tweak some of the rules around the RAG scoring, maybe some of the functionality, but that can usually be done in a matter of days. So someone can be up and running certainly within a week, no problem.
Okay, thank you. Okay, we'll move on to our learning objective 2, which is understanding the current state of development of climate risk models and APIs, which Alistair McGregor from Sust Global is kindly agreed to do. Over to you, Alistair.
I was struggling with the controls on mute. Thank you, Feargal. Right, start again. I'm Alistair McGregor. I'm the COO at Sust Global. So at Sust Global, we are all about enabling the climate economy, and we do this by providing the foundational data layer. So in doing so, we empower our users in business, finance to access best-in-class and validated climate risk data. So this is data that they can then use in business decisions in this emerging environment. So as Feargal said, I'll be giving you a brief introduction and looking forward to lots of questions during and at the end into physical climate risks. So first of all, I will quickly touch on what we mean by physical climate risks in a little bit more detail. I know that you will be familiar with a lot of these and the data inputs that we need for physical climate risk analysis. So when we're talking about physical climate risk, we're talking about acute risks. So we're a lot of talk just then about flood. We also touched on wildfire. We also look at cyclones, heat waves, but we're also looking at drought, chronic risks such as drought, water scarcity being different from drought in the sense that it also considers the demand as well as the supply side of water, and also, of course, sea level rise. So how do we identify these physical climate risks? Well, you always start with these global climate models, and these are incredibly powerful, huge, complex climate models that are made. They're publicly available. They are created by organizations such as NASA, the UK Met Office, leading universities, and they are put together by huge teams of climate science. They're incredibly powerful. They're not intended though for business purposes. So you can augment those models with other data, so other geospatial data, including satellite data. Then of course, to make it useful for businesses, you need to know what location you're talking about. So you need asset location data, and that can be a zip code, but also a specific, as Richard was talking about, you can go down to a specific asset location. And then depending on the use case, you need to understand the financial implications of that physical risk in that location, or not either on the asset itself or on the activity that's occurring at that asset. So now I understand that most of you on this webinar are based in the UK or Ireland, and therefore have a primary interest in the UK. But I'll also talk a little bit, as Feargal mentioned, about how UK businesses are exposed globally. We see all businesses wherever climate change is a global issue, and it impacts businesses regardless of where they're based and how they unfold throughout the world. So I will come on to that in a moment. But here we have this is an actual UK business. Each of these dots on the chart on the left, this is based on Sust data, is an asset location, a physical site of that business. The color coding represents our measure of whether it's low, medium, or high risk, so green, yellow, or red. And here I've drilled into a specific asset location in the northwest of England. And we can see that historically, we're looking here, just at the flood risk. We're not looking at other hazards or perils. We're just looking at our measure of risk associated with flood. So you can see here that for this specific location in the northwest of England, there has been one event in the last decade, one flood event. And then on the right-hand side, if you can see beneath our pictures, you can see how that flood risk increases over time. Now you might say, wow, 2040 is a long way off in insurance terms, but of course, climate change is not happening in a linear way, and extreme events can come at sudden times. And also, in addition to that, the impact on asset prices. I appreciate we're mostly talking about underwriting here, but Feargal did mention that there may be some of you mentioned in the investment side. These risks the impact on asset prices gets reflected much earlier than when the assets hit themselves. So we're talking about the UK here, but imagine in North America, in the wildfires we've seen there, we are even the buildings that haven't been hit yet, the insurability or asset value of those has been hit substantially already. And of course, it creates an opportunity as well as a risk for insurers in pricing insurance correctly. So here we're looking at the UK, but what about when we start looking overseas? So this is the same business, a real business, and it has these asset locations. Here we're looking at their assets in Europe, Southern Africa, and Asia. And again, we're just looking at flood risk here. And I should say that although we're looking at a very banded low, medium, and high, which we depending on the hazard, we have strict and disclosed criteria that we band them to. This is underlying this data is the precise data itself, not just the bands which you can have access to. So we'll see. You can see here that although it had some flooding risk in the UK, it's also got substantial flooding risk in its sites around the world, in Europe, in Southern Africa, and of course we've just heard in the last few days about those terrible floods in Durban. And also in Asia. And then we can add in other hazards as well. And of course, when we look globally, this becomes increasingly relevant. So here we've added in wildfire. So again, a lot of fire risk throughout Europe, Asia, Southern Africa, but also in North and South America. Here it doesn't actually have any sites in the Pacific Northwest, but if it did, they would obviously be substantial from wildfire. And then we can also add in cyclones. So here they have a facility in South Korea, which is exposed to cyclone risk. And as I mentioned, and as I think Feargal mentioned earlier, that this isn't just about from a business interruption perspective. We have had inquiries from the insurance sector about business interruption through supply chain risk. This is just operations. So when you add in supply chain risk as well, these risks become magnified through the business. So I'm going to dig now, I touched on the sort of data inputs at the start. I'm going to dig now into a bit more detail about how we measure physical risks. Now, so you start with these big global climate models. These are the NASA models, the Met Office models, the university models. There's sort of three challenges with those. And when we talk about measuring physical climate risk at Sust Global, we're always talking about creating business intelligence from business intelligence ready physical climate risk data. So we start with those climate models. Now they have three main issues. One, they're not always global, or where they are global, the coverage isn't always perfect, or there's the weaknesses in certain regions. Secondly, they can, because they're not meant to be asset location specific, they can lack granularity. And the second or the third thing is, as I mentioned, is they're hugely complex. So unless you have a team of climate data scientists in-house, and even if you do, it can take a long time to understand the data on a case-by-case basis. They're not particularly useful. So we're trying to deal with all of those weaknesses of these underlying climate models and improve them in other ways too. So the first thing we do is layer in this other geospatial data. So that could be satellite data, it could be data that and that could be about land cover. Of course, land cover is critically important for climate risk such as wildfire and flood. The type of land cover dramatically impacts the risk from those. And then, of course, economic data impacts the potential change in land cover. So we bake that in as well. And then the third thing we do, which is really fundamental to our proposition, is that we use satellite data in real time to observe where events are actually occurring. So where are the wildfires, where are the floods, where are the cyclones? And by understanding that real-time data versus what the models are saying and using machine learning, we can improve on those models both in their resolution and in their accuracy to provide more business useful data. In terms of the scope of our models, we cover the 7 climate hazards that I talked about. Fundamentally, and I'm not sure if Johnny will touch on this, but it is really important to understand there are different climate scenarios. So even if you're not particularly familiar with climate science, you'll have heard of 1.5 degrees, 2 degrees, 4 degrees. So we, given the uncertainty in where we're going to land there, we present different hazard risks under those different climate scenarios, risk being a function of frequency and intensity. And then great data is great, but it's not much use without being able to be easy to access. So I would reiterate what Richard has said, and very much we're aligned with Gamma on this in making data really easy to access, and principally that's through making it easy to integrate with APIs. And the reason, as you've seen, we do have a dashboard with those graphics earlier from our dashboard, and the one on the bottom right here is from our dashboard. But the reason we've taken an API first approach is that there are so many different use cases for climate data, and that's only going to increase. I mean, we really are at the beginning. We're sort of the equivalent of 1999 and sort of Web 1.0, and we are going to see dramatic change in the needs and application of climate risk data across all these different use cases. Of course, insurance underwriting being a key one. And very quickly at the end, I'm going to just touch on a use case, because I think case studies are always a great way to bring data to life. So I've chosen a private equity case study. The reason I've chosen private equity is A, because it's public and I can talk about it, and B, because I think it has a lot of commonality with the insurance use case. You can both look at a private equity portfolio in the context of the aggregate portfolio at risk in an insurance portfolio, but also from a due diligence perspective, you can see how due diligence in a private equity context is like writing new policies. So in this case, BC Partners, a user of our data, wanted to understand the risk across all their portfolio companies. So you'll probably get the gist from here that it's quite a messy and complex exercise. They had 500 different asset locations across their 27 portfolio companies. They were able to very quickly understand climate risks across 3 climate scenarios, across 7 different climate hazards everywhere in the world for those different asset locations, and immediately able to identify that 3 of their portfolio companies were at high risk from physical climate hazards. So that could be equally have done to a book of insurance, and then of course they can use our data going forward for due diligence. So a bit of a whistle-stop tour of physical climate risk, but I hope you found that interesting. And so now back to Feargal and over to Johnny.
Thanks, Alistair. A quick question's just come in. Can the physical climate risk data be back tested, and what have been the results of these?
Yeah, it's We pride ourselves on the transparency in our methodologies, but also in the validity of our data. So we're obviously testing it in real time with satellite data, but we also back test the existing models against actual hazards. So probably the best case that I can talk about is where it's been used in the mortgage-backed security industry in North America, where they back tested our data against actual, we back tested our data against actual climate events. And that's had an R-squared of between 60 and 94%. But they've also backtested our data. That's fine, but actually what does that mean in a business context? And they've also backtested our data against a prepayment and default risk with positive results. So yes, we do this and encourage our users to do this too.
Wow, that's very impressive. Okay, thanks, Alistair. So next up is our next learning objective. We want to get to the slide deck up. So it's Johnny Mattimore from FD is going to tackle this one, which is looking at the regulatory requirements and identify potential requirements for MGAs in this space, particularly in next generation pricing, valuation, and risk. So over to you, Johnny.
Thank you very much. Can everybody hear me? Yeah, perfect. Hi, everybody. So the three objectives here. I'll do a quick whirlwind tour. We're going to look quickly at how risk has evolved over the last few decades. We're going to see how it will change over the coming decades, specifically to do with climate risk. And then we're going to look at how to combine both traditional climate risk data for pricing, valuation, and risk. So our business sits slightly downstream. So you've got Sust Global providing very specific, detailed information around a very defined domain. That's compatible with the specific work that Gamma does. And what we're doing, we're taking all of that data, we're ingesting it into systems of insurers, banks, and asset managers, and then we're putting that to work as a physical technology solution in all of their workflow. And that's from people writing business to people managing the claims, all of the technology, data architecture, data taxonomy, and the reporting to the regulators. Okay? We're dependent on their data, their capabilities, and we integrate into our clients' platforms. So here's setting the scene. Some of you will know some of this, so I'll whiz through it. I want to give you a quick framework of the evolution of risk and the importance of data. So for this, I'm actually going to use banking because banking's moved a little faster than insurance, and whatever is happening in banking, all of the design patterns around the data solutions are equally important and relevant to insurance. They're almost identical. There'll be different subtleties, but there's a massive convergence between the interests of banks, insurers, and asset managers are all getting the same type of data. And whether or not that's physical data, transition data, or emissions data, they all need it for different purposes. Over time, they're all merging into the same reason. They need to price new business, periodically revalue it, hedge it, and then finally they need to make sure their risk models fully reflect those assumptions to be able to backtest them. So what I've done here, I've used the Basel framework for banking from 88 onwards and show how this is all traditional finance. It's all structured finance, actual data, it's orderly, it's easy to get hold of nowadays, it's a very mature market, but we're about to embark on Basel 5. It's a bit like a climate version of Solvency 2+. It's going to have a profound impact on gathering data, which is non-traditional, it's not financial, it's not structured, and it does not exist in the financial domains of banks, insurers, and asset managers today in the economic form they need it to be in to actually be able to price, revalue, and manage risk on their portfolios. And this is how it's evolved. It started off with people having very little data and a lot of judgment. We're now moving into the other world where we're dependent hugely on machines and vast amounts of data. So the computational intensity is vast and it's only going to get bigger. And therefore, how do you interpret that data? We're going to need much better visualization tools. And you'll look at the user UIs that both of the other partners have demonstrated. There's no way of getting around this. The data is too big for a human to actually make sense of without very sophisticated visualization tools. So now we'll jump to what are the problems we're trying to solve. We're trying to take traditional data, structured and financial in nature, and combine it with climate data, which is non-financial and it's unstructured in nature. So the first impact on business is the horizon difference. If you look at how we manage our business today on the left-hand side, the time horizon is relatively short. It's 1 day to 1 year. And if you look at climate risk modeling, it's 10 years out to 100 years. The real imperative with governments setting decarbonisation mandates is going to translate into financial services and real economy. So we've got around an 8-year window between now and 2030, when a lot of countries are looking at almost halving their carbon emissions. So a big chunk of the work we've got to do is to bridge the 1 year to 10-year gap. And then beyond that, we've got very longer dated climate models. Now, for anybody who knows anything about using models to price new business, revalue, and manage risk, the longer the dated the model, the much more sensitive it is, and hence the greater chance that there's model risk. Model risk basically is error risk of getting the pricing wrong, the revaluation of the risk wrong. Next thing is the integration of data and models. It is going to become much more demanding on the type of diverse data sources and vendor products one's going to have to integrate. These products are not mature yet, so there's an added complication. You can't simply select one, be satisfied with the piecemeal quality assurance you do at a point in time. For the next 10 years, it's probably going to have to be quite an agile environment where you're refreshing the quality assurance on any of these. I've done a sample of catastrophe, climate, and ESG vendors. Catastrophe are definitely the most mature. Climate vendors are the next, but a huge range of them, and they're ostensibly meteorological models which have been modified to turn into economic models. That's a very big potential model error. They were not designed for economic loss, most of these climate models, so there's a real complication on what comes in the next generation of models. ESG vendors, very different again. Huge variation from high quality providers right through to those who are basically selling snake oil. But this is the bonus for everybody. It's actually a data problem. We're not going to change risk models. We're not going to change the mathematics. All of that remains the same. But the real challenge is how do you get the data in climate risk economic ready so that you can use it in all of your existing models. And what I've done here, I've used an illustration on the left-hand side. Traditional finance we take for granted, but it took a long time to mature. Yeah, it's about 100 years for us to get to the quality of structured financial data that we've got today. In climate data, we're trying to achieve that for physical risk and emissions in under 10 years. We're trying to get there realistically within the next 2 to 3 years. There is hope because there's a lot of initiatives to actually generate that data, but more importantly, there is computer technology, especially in the areas of artificial intelligence, machine learning, text-based NLP, and neural networks, which are actually contributing to this enormously. But the quantum of data is vast. It's so much bigger than what we have currently, which is already enormous in traditional finance. So I want to give you some ideas on what are the new frameworks. We've talked about how do we get different scope emissions into the system, what are the regulations coming through. So I'm going to give you just a sample of the way to think about this, because nobody's solved it definitively. So one has to start thinking about solutions with partners which will mature over time. And what we've done here, we've demonstrated how banks are already thinking about this. And banks have traditionally priced their products and their services based on credit risk. So you've only got one dimension. You've got about 20 credit ratings from AAA down to D for default. So from 20 grades of credit ratings, if you're trying to forecast risk 1 year out, you've got 20 possible states that could migrate to from its current state. So you've actually got 400 outcomes. Now, if you think about adding a new dimension, a proxy for climate risk, that could be you want to concentrate on physical risk or you want to concentrate on emissions. You're going to add another dimension, that's another 20 outcomes. So now you're going grades, you're going from 20 grades to 400 grades. And you'll see on this slide, I've just demonstrated if you actually then want to modify the state of an asset or a product, is it stable, improving, or deteriorating, you've got another 9 outcomes. So you're actually entering into a much greater quantum of data. Now, we jump to insurance, and let's assume you use a proxy for product risk on the x-axis and emissions risk on the y-axis. You've got the same framework, which goes back to what I said. If you look at the design pattern that we use for solving data problems in banks, it's the same type of design pattern we use for solving in insurance. Okay. Now, the added benefit of this, you get a much more granular framework to try and identify whether or not you've priced things properly and how you revalue them. So previously, you could have everything moving in a vertical column on the x-axis, and you actually wouldn't know you're running a risk. Here, I've given 2 examples where it moves in the vertical, which you wouldn't typically capture, but because you're monitoring emission risks, you've got an improving example and a deteriorating example. These are lead indicators for why your one-dimensional pricing is inferior to the 2-dimensional pricing. And then this is how this will evolve in the next few years. We'll take the baseline pricing, we're going to add new data as it becomes available, new sources, and so you're going to expand overall, and you're going to have quite a dynamic data environment to do this well. Okay. Key takeaways. Number 1, insurance is following banking. It may not be your domain, but do look at banking. It gives you a lot of lead indicators for what's coming to insurance. The next thing is risk data. It's about getting the data economic ready, translating emissions into economic data. And then finally, we're going from 1-dimensional to 2-dimensional risk metrics, which means massive increase in data volumes. And I'll stop there. Thank you.
Thanks, Johnny. That was very whistle stop. Just a quick question has come in there asking how mature are the data solutions in the market?
Well, I'm happy to take that. We find them extremely immature. We're finding great inconsistencies in data vendors, and we're finding people are simply scraping data from the web, and the quality assurance around it can be very poor. And therefore, the very first stage we get involved with of looking at client problems is not designing a solution or a solution architecture top to bottom. We start invariably with how can they even go through a quality assurance and vendor selection process. And we've got a lot of experience with market data in that sphere, but they're not terribly mature. But there are pockets which are really high quality, like certain financial institutions, the data they're disclosing through TCFD. But getting granularity is extremely hard. It's going down to the asset level, which is hard. You can get portfolio information much easier than you can get granular information.
Great, thanks, Johnny.
Perfect timing. Perfect timing. We're just about to the point where we need to wrap up. So thank you to Feargal, Richard, Johnny and Gamma. Oh, and Alistair, sorry, nearly forgot you. Thank you to all of you. That is so informative. I do love a bit of visualization myself, so all of that is brilliant, but so much information to take in for everyone. I'm sure there'll be questions afterwards, but if they come in, we'll send them to you to follow up. Thanks to everyone for joining us. Please don't forget to provide your feedback and look out for forthcoming MGAA events. Have a great afternoon, and we'll leave you there.